All right. Good afternoon, everyone. Good morning, good evening, depending on where you're joining us from today. We are just about to start our webinar on Finance Act 2025. This is the Kenyan Finance Act. And before long, we will be finding out whether it was a game changer or we still remain business as usual. And before I say a lot, maybe just a short introduction about our firm, Dennis. Well, so Cliff Decker Hoffmeyer is among the largest business law firms in Africa, with offices in Cape Town, Nairobi, Stellenbosch, Johannesburg, and Windhoek, Namibia. We have more than 260 lawyers, more than 100 partners, and the firm has been here for 170 years and in Kenya for about 7 years now. And some of the things that we stand for include ensuring that our assignments are partner-led. We are quite specialized in terms of our practices. We work together, with our partners to deliver value to our clients. We empower our clients, and we also value our reputation. So that's just a brief overview about our firm. Just the next slide. Well, so as we get into the topics of today, this snapshot, I'm sure Abraham will be speaking about it. And at this point, I just want to introduce our speakers. And then we will have Dr. Abraham Rugo coming in to give us a presentation for about 15 minutes. Just an introduction of our speakers. Dr. Abraham Rugo is a passionate advocate for local development and good governance in Kenya, with over 20 years of experience in decentralization, public finance management, and citizen engagement. He has worked to improve government service delivery through research, public policy advocacy, and educational outreach. He currently serves as the Executive Director of Budgety Hub in Nairobi and holds a doctorate in public management from the University of Potsdam. He believes in being locally rooted, globally connected, and finds fulfillment in helping people and teams flourish. As we continue, we'll have also two panelists joining us, and also we'll be hearing from them in terms of a Q&A session that we'll have towards the end. We have Cynthia Koech, who is an experienced tax and accounting professional with over 20 years of experience in both practice and industry. Cynthia started her career as an external auditor before kickstarting her career in tax at PwC. 2 years later, she served clients in various industries while at PwC, tax advisory, litigation, and compliance. She later joined Kenol Kobil, Rubis Energy as we know it today, as the group head of tax. And she's currently the group head of tax at Safaricom PLC, where she's responsible for tax strategy, tax planning, and policy, including litigation and compliance. Our other speaker is Christine Miner. Christine Miner is the CEO of the East Africa Venture Capital Association, IAVCA, where she drives efforts to expand private capital flows and elevate East Africa's profile as a leading investment hub. She brings over 16 years of experience in business, trade, and investment across the region, with expertise in leadership, strategic communications, and cross-border advisory. Christine is a firm advocate for private capital as a catalyst for sustainable development. With that, just to tell you how our program will run, we'll have about 15 minutes of a presentation from Abraham. We'll then have another 15 minutes presentation on the Finance Act. We'll thereafter have a panel session with our panelists today before opening up for Q&A. But in the meantime, please feel free to type your questions in the chat, and we will attempt to address those questions at the appropriate time. So without further ado, let me welcome Dr. Abraham Rugo for his presentation on the economic and fiscal outlook. Karibu, Dr. Abraham Rugo.
Thank you very much. And please confirm that you can hear me and you can see my slide.
We can
Alex,
hear
confirm.
you, and the slide is perhaps coming up. Yes,
On my side, it's already showing.
on the introduction. Welcome.
Good. Thank you very much. So it's my pleasure and thank you for the opportunity to share. I work at Budgeti Hub, where we engage on matters of public finance to collaborate with the citizens from all walks to support and accompany them as they engage as we work towards transforming our country, Kenya. And I will not, you know, a little bit more about who we are. I will just go straight to my presentation. The way we have structured this presentation, and when I say we, because it's a team effort, even with my colleagues at Budgeti Hub, is to ensure that we can be able to have an. Just a second, I think I am. Can you see my presentation?
Yes, we can.
Good. So the way we have prepared this presentation is in such a way that we can be able to share a couple of things which I'm going to ensure that we focus on. So in terms of just by way of introduction, so because it's a macro fiscal picture, I'm going to go a bit into some things perhaps we don't discuss every day when we talk about public budgets. So, for instance, I'll spend some minutes on what are some of the key drivers that are affecting the context of the 2025-2026 budget. The first of all is to just re-emphasize that public budgets are the most effective tool. Actually, in fact, we believe that whatever is not in the public budget does not exist. So it is the critical tool, basically, of how government deals with poverty, deals with with ensuring that there is equitable transformation within society. But secondly, it's about decisions, and that physical decisions by government have a direct impact, in the development of the country, as it were. And that has implications in terms of whatever development you're thinking about, whether you're thinking about education, whether you're thinking about the growth of children in food security, even in terms of the political development, as it were, because you have to allocate resources for that. But public finance, it's not just about money. It's about how efficiently we allocate and prudently spend and account for money. And that's critical. Our constitution in Article 201 does make a provision that it's all about accountability. And of course, public finance systems, the system in place does influence. So for instance, we have a system where we have the treasuries, then you have the parliaments, both the National Assembly and Senate at the national level, county assemblies at the county level, and how they interact, has direct implication in terms of how the economy plays, including how it affects the cost of living. So what is then the fiscal context? When you talk about the fiscal context, we are talking about what kind of environment is this particular budget going to be implemented in? The first one is that we, as a country, have adopted zero-based budgeting. It was adopted by cabinet, and it's have been used in the 2025-2026 budget estimates. To what extent that is the case, I think still bears out, because as you know, zero-based budgeting means starting from the ground, where basically you build your budget from the very scratch. Every department, every agency, every ministry justifies why they have to continue spending in a certain direction and not the other. So we wait. The second thing is that there is a new budgeting manual that has been published, by the National Treasury, that includes a costing module. This is important because then it starts giving you an indication of, if you have X amount of money, how many classrooms can you build? How many health facilities can you build? How do you, how many kilometers of roads, can you be able to develop? But thirdly is that it is in a context where revenue-driven fiscal consolidation, in other words, trying to balance our budget by mopping up and raising the revenues, has actually hit limits. And is not delivering the needed relief for the public purse, especially due to debt servicing. Now, as you might know, some of us perhaps are not aware, Kenya entered into an arrangement with the IMF in 2021, had a fiscal consolidation, which basically had to do with how do we better, largely two sides. You improve your revenues or you manage your costs. And therefore, this one was going to be revenue. But as much as that is the IMF and Kenya pulled out of the arrangement because it was definitely not delivering, especially after even the rejection of the finance bill last year. And the last point is that accountability and governance challenges remain our Achilles heel in PFM. The reports from the OAG, the Auditor General, reports from the Control of Budget, that waiting discussed by both public investment and public accountability committees of Parliament, bear this, that basically, we still have quite some long way to go in terms of accountability to make sure that every shilling is being spent for the purposes for which it is supposed to be spent. So what is the overall budget? So this table gives you the overall budget, as you can see, and it does, if you look at that column, first of all, you notice that the budget for 2025 has been revised 3 times. So we had the estimates that were approved by under the budget policy statement. We have the budget estimates that had been tabled in Parliament and that were finally published. And even some of these numbers, we understand, may have changed just slightly, especially the amount going to county government went to 415, but the consolidated fund services, which is basically the non-discretionary spending, is at 1.33 trillion. This is in trillion, so this is the amount you see. Look here is in billions. So 2,498 billion is the amount we are spending on the national government, of which 2.428 is on the executive, and of that about 700 billion. Now keep that number because I'll refer to it later. 700 billion is for development purposes, in other words, for capital projects, as it were. Then you see the amount of parliament and judiciary, but then the next table shows you that we are spending significantly huge amount. If you look at the interest alone, we are spending about 1 trillion Kenya shillings. Now, this table does not include debt redemption or the principal payments. If you add the principal payments, which are about 600 billion, then you already are at a figure of about 2 billion against a revenue figure that I will be showing shortly. So having kept that overall budget, let's look at 3 things that we are really concerned. The first one is the public debt. Now, public debt is going to shape a lot of the conversation that we are going to be having moving forward. One, because first of all, the stock is now at about 66.9% of GDP, and this is a GDP number, if I'm not wrong, of about 19 trillion. There's a debate of what is the actual GDP figure, because some numbers take you to about 17.4 trillion, some numbers take you to 16.2 trillion, and some numbers take you to about 19.1 trillion. I mean, that's a discussion. But an interesting bit is that our domestic debt is now becoming the greater proportion of this figure. And you see how this looks like, both of GDP but also aggregate. So 53.6% and then 46.4% against the external. Now, one would argue that this is perhaps a good thing because then we are borrowing in our local currency. But as you know, debt has got 3 major risks. The first risk has to do with forex exchange, which basically affects for the debt that is procured in foreign denominated currency. The second one, interest rate, that is where the domestic debt is falling because our borrowing has been in double digit for the longest. And the third one is the quantum of service payment of the payments, the installments, which currently, as as I've just shown, is already quite on the higher side. Sorry, the next point shows that. So we are currently dancing at about 65% of our ordinary revenue, which basically means of every 100 shillings that we collect, about 60, 69% if you add debt redemption goes to debt repayment. And when you think about that, even in your own business, then how much you have for development, how to build a business. In 2025, 2026, that has remained at 69%, and in 2024, it was at 70%. In other words, for the last 3-4 years, we've been spending over 60%. So that's going to shape a lot. This year, our deficit already has increased to about 923 billion, of which about 600 billion is going to be borrowed locally, which then means that has implications.
Just a moment, Dr. Abraham. Maybe you could drop video so that we get better sound quality.
But that is about deficit. It's about expenditure. Discipline this way, 24, 25, which again there was an income, and already we have the deficit has actually increased just even by the time we approve the budget. And therefore, a supplementary budget is borrowing instead of, so that when you don't hit income targets, typically you should reduce the is revised. This is that has affected, how our the red against our. Hear me? Hello,
Dr. Abraham, we can't hear you. Your connection seems to be faltering. Just try again.
let me try and change my connection.
All right. In the meantime, we shall present you.
Is it any better now?
Yes, just keep talking, please.
Any better?
That's better. Yes.
My apology about that. So let me just continue to where I had stopped. So can you hear me now?
Yes, we can.
My apology about that. So I was saying that the more you continue borrowing, and especially borrowing domestically, then you end up with the situation that we have here, which is that last line before even I explain about revenue targets, that credit was at 2.4% as of March of 2025. This is perhaps the highest we have had, because what happens then, if government is competing with private sector in the same market, then government is almost an assured borrower, because then they are going to pay, because we are going to pay our taxes, or rather we don't have an option, but we have to pay our taxes. But when you look at the revenue targets, the downwards in 20%. The domestic borrowing targets were increased by 29% and external borrowing by 20%. And you see, that is what I was saying, that on one hand, you revenues are going down. On the other hand, you're increasing how much you're borrowing by even 2 times higher. By even 2 times higher than you had indicated that you need to. Sorry, can you see my presentation?
No, we're not able to see your screen, but let's help you to project and then you just skip to voice.
Okay, please go ahead.
Let us
So
know if you can see the screen now.
I can see it. The next slide. So I'll borrowing, and that means that we have so on one hand you're borrowing a lot from the market, you're not paying your obligations. Now this table shows you the pending bills that we had as of end of June, end of 5 at 706 billion, and we break it by 82% of those pending bills are the state-owned enterprises or entities, whichever you like, at 421 billion. Pay as you earn, in other words, these are deductions that are made by national government institutions but are not remitted to KRA, 21.47 billion, and then pension, the 35.5 million. You can say that's a negligible figure, but it's still an important one. Of the counties, 7% is from Nairobi County. Then the rest, and 81% of the pending bills are actually recurrent in nature. They are not for construction or anything. Now, this is important because, as I've said, government on one hand is taking away and crowding out private sector from the credit market, but on the other hand, they are not paying their bills, which then means that then private sector is almost subsidizing public sector as it were. Next slide. So the revenue targets is what I was discussing, and I was saying that every year you notice that the original estimates, the revised estimates, and actual receipts, almost every year, basically we have actually been moving. As you see there, this is as of 31st of March of 20. We know very well that the final numbers, KRA had actually hit the target, but the target again revised estimates, and as I've shown earlier, and I was just explaining, we revised our borrowing upward. Next slide, as I bring this to a close. But it's important for us then to ask, so but what is the problem? So if on one hand you are borrowing, why is it that GDP growth is not driving the kind of change we want? It's interesting because the Kenya GDP growth has remained above global averages. So we have been at about between 4 and 5.2%. Global average has been at about 3.8% or thereabout. But what we notice is that growth is being driven primarily by two sectors: financial and service sectors. Now, it's important for us to remind ourselves that the service sectors, largely we are talking about, hotels, we are talking about different conveyance, as it were. Financial, we are talking about lending. Now, as you know, as you have seen, government is the biggest borrower from financial institutions. Then we have a lot of people who are borrowing, money to be just to survive and what have you. Only lending really not may reflect expansion in money in the private sector businesses, so you better than that. Secondly, these are sectors between tech, the sector employment, right? But has incomes to go filling the
Dr. Abraham, your connection seems to
income,
be faulting
have
again.
a great impact. So, okay. Any better now?
Yes, it is.
Okay. Good. So I'll continue on where I stopped. If you could just take me to the next slide. So this slide shows you, no, the next one, which is technically my last slide. So what this slide shows you is, so you notice that between 2008 to 2012, really both in private sector was leading, followed by not so much by the public sector, but remember private sector has got quite a significant much as compared. Has more employees, as it were, about 2.2 million compared to about 1 million within the public sector. Was declining up to 2012. Then from 2012, you see a steady increase, a bit of a stability there up to 2020. Then from 2020, which is the last 5 years, it's been a downward. Now, real incomes basically means this is the amount of money that is available to households to be able to spend. Now, when real incomes decline, what basically it means is that, first of all, personal income tax will decline, but in the same period where you have had taxes increased and other extra tax measures like the housing levy, the contribution to the social health insurance. So incomes have actually been on a decline since COVID. Remember, COVID already had an implication that a lot of businesses closed down, a lot of people lost their jobs, and therefore, and especially within government sector, in terms of government employees, where incomes as generally tend to be slightly lower than within private sector, that has implications on private personal income tax, and that has huge implications in terms of how then we do progress. I think this should be the last slide. Next slide. So thank you very much. 3 points, just as I tie this up. One is that we have a budget that shows a growth in terms of how much we want to spend and how much we plan to be able to collect in terms of revenue, and that will be discussed a bit more. We also have an indication of how much we plan to borrow, because that is increasing. But of concern is that since incomes are not growing, and this is the same group that you target to be able to collect revenues from, that may have huge implications in terms of how much tax you can be able to collect, how much you can be able, and if time allowing, I would have shared something a bit more in terms of how the incomes we are talking about are distributed, because out of the 20 million, 3.3 are within what we call formal employment, 17 million are what we call informality, which is basically is difficult to tax, both because administratively, but also now because of just the quantum of incomes that are available in that level. Thank you very much. I'll stop there, and sorry so much for all the mix-up. My apology.
Right. Thank you, Dr. Rugo, for that presentation. Don't worry, just hang on, because we'll have the Q&A and the panel session coming in a few. But before that, let's have Dennis Minor, who is an associate at the firm, then give us key highlights of the Finance Act, and then we will go straight into the panel session. Over to you, Dennis. You have about 10 minutes.
Okay. Thank you so much, Alex. You can confirm you can hear me?
Yes.
Okay, awesome. So I'll be taking you through the key highlights for the Finance Act 2025, and for purposes of this webinar, we've focused our presentation on the sector-wise. So starting with the financial sector, we've seen the government try to incentivize this sector by trying to encourage investments into Kenya, where they are trying to position Nairobi as a financial hub. And for this, they've introduced incentives in the Nairobi International Financial Center, which we call NIFC. And for this, they've introduced preferential CIT rates at the rate of 15% for the first 10 years and additional 20% for the next 10 years. This is for certified companies, as long as they meet the 3 conditions. And the conditions are you must invest at least 3 billion shillings within 3 years in Kenya. And if you are holding company, at least 70% of your senior management has to be local employees. If it's a regional headquarter, then at least 60% of the local employees should be in senior management. So for startups, we've seen a preferential tax rate of 15% for the first 3 years and additional 20% for the next 4 years. So other than that, any dividends that are paid out to NFC certified companies will be exempt, provided that the company reinvests at least 250 million in Kenya. So another incentive that has been introduced in this sector is that withholding tax on qualifying dividends and interest will be a final tax. So you will not be required to pay any other tax once you've received your dividends and interest. In the real estate sector, the finance bill had tried to remove some of the incentives in that sector, but following the public participation process and the committee recommendations, Parliament retained the current incentives, being the preferential tax rate of 15% for developers of units of more than 100 residential units, as well as VAT exemptions on any goods or inputs for the construction of affordable housing. And this is in line with the government's affordable housing agenda. Interesting as well, they've introduced interest deduction. So you are allowed an interest deduction of up to 360,000 for any person who takes up any home ownership loans. So that's a welcome move in that sector. In the digital and technology sector, we've seen the Finance Bill 2025 had sought to reduce digital setups from the current 3% to 1.5% because this was following stakeholder engagement with the non-resident entities which were seeking the rate to be reduced. But Parliament thought otherwise, and this tax was repealed. So we no longer have the digital asset tax. But interesting, we saw the inclusion of excise duty at the rate of 10% on the fees which are charged on the virtual asset transaction. And this is following the introduction of the virtual assets bill, which is still under the is still in Parliament for discussion. In the same sector, we've seen that the government has increased the scope for the significant economic presence tax, which was introduced in December. So they've now cast the net wider to include services which are offered in internet networks, internet and electronic networks. So it will no longer apply to digital marketplaces only. And they've also removed the de minimis threshold of 5 million, which had been set. So this means that any non-resident who offers any services through internet and electronic networks will be required to pay SEPT, which is currently at 3%. The effective tax rate is 3%. In that regard, we understand that the regulations for SEPT will be published within the 6 months. So we'll be looking out for the same and then to see how these new tax will be governed. As well, we've seen the introduction of excise duty on digital services, and this has been reintroduced to cover the non-residents in an effort by the government to cast their net wider. In the automotive sector, this is one of the sectors that the finance bill had sought to remove the incentives, but again, following lobbying heavily by stakeholders, the Finance Act has retained the incentives that had been sought to be removed, which is the preferential tax rate of 15% for any local motor vehicle assembler, and this incentive is not only for the first 5 years. If you want it to be extended, you apply it to the cabinet secretary. Again, any supply of electric bicycles and electric buses, it was the finance bill had sought to change this from zero rated to standard rated, which is 16%. But again, following the committee recommendation, it has been retained at 0%. In the manufacturing sector, again, we are seeing the retention of incentives that had been sought to be removed. So the 100% investment allowance for any company that invests more than 1 billion outside Nairobi and Mombasa had been proposed to be removed. But again, because of heavy lobbying within this sector, the government has sought to retain it so that to incentivize people to invest outside Nairobi and Mombasa counties. An inclusion that was not in the finance bill was 10% investment allowance for any telecommunication operator that provides spectrum licenses. So that's a welcome move for the telecommunication sector. And then in the VAT Act, we've seen the introduction of a segment of distillers called micro distillers. And basically these are people who produce less than 100,000 liters of alcoholic beverages within a year. So for them, they've been brought into the ambit of VAT and excise duty. However, they've been exempted from the automation and mass flow meter requirements. So for them, the KRA will monitor the production using what we call the excise stamps, which are normally attached to any goods that are produced from the factory. In the same sector, we've seen introduction of levy on iron and steel at 17.5%, which is an increase from the previous 5%. So in deals and structuring, we've seen an introduction of an exemption and a removal of another. So the Finance Act has introduced stamp duty exemption on any property transfer that involves a transfer to shareholders, as long as that you meet the two conditions, which is property has to be transferred to the shareholders in proportion of their shareholding, and the shares have to be in a subsidiary of the company that is undertaking the transfer. Similarly, the current CGT exemption, which was provided to companies investing in SEZs, has been limited, so that any gains from the transfer of property within an SEZ is now limited to licensed SEZ entity. Meaning, if you had invested in an SEZ entity, but yourself, you're not an SEZ entity, then this exemption will no longer apply to you beginning of 1st of July of this year. From a transfer pricing perspective, we've seen the introduction of advanced pricing agreements, which is a welcome move, which has been lobbied for a long time. And we are looking forward to the regulations, which should be published within 6 months. And we'll be looking to advise our clients in terms of taking advantage of these agreements, especially if you have related party transactions. Similarly, the transfer pricing sector, the Act has clarified that minimum top-up tax will be payable by the 4th month after the year end. So this aligns with the current CIT timelines for resident companies, which is normally by the 4th month of the year end. In the betting and gaming sector, we've seen introductions which were not previously in the finance bill. And the first one is excise duty at 15% on the amount wagered has been reduced to excise duty at 5% on the amount deposited by people who bet, as well as withholding tax has been reduced from 20% on winnings to 5% on withdrawals. The only challenge is that for withdrawals now have both winnings and any amount deposited. Whereas the rate has reduced from 20 to 5, the tax base has increased. So that's all for the betting and gaming sector. Next, I'll be looking at some of the key highlights in terms of tax administration. So the key one is the carry forward of tax losses has now been limited to 5 years. With a further extension of 5 years upon approval by the CS. Previously, this you could carry forward your tax losses to up to an indefinite period, but KRA have now sought to reduce this period to 10 years. Yeah. In terms of enforcement measures, the government has increased the enforcement measures to also include residents, so that they cast their rider, and the issue of agency notices pending any appeal has been dropped following public participation. Again, from a tax administration perspective, the minimum tax has been dropped, and this is just to align with the Court of Appeal decision, which declared minimum tax unconstitutional in 2022. We've also seen an introduction of a requirement to have a certificate of origin by importers. And whereas this was to take effect from 1st of July 2025, the KRA has issued a notice to give any importer a transition period of up to 30th September 2025. So from 30th September 2025, we'll all be required to have the certificate of origin. Again, another area that has been highly controversial is the integration of taxpayer systems with KRA. So this was heavily contested in the Finance Act 2025, and subsequently it was dropped because of the controversy around data privacy and trade secrets. Finally, the timelines for application of VAT have been reduced from 24 months and to 12 months. So taxpayers will need to keep track of any VAT credits that they have so that they align with their timelines. So the next slide. So the question that we're asking ourselves is the Finance Act 2025 a game changer, or is this business as usual? So based on the proposals in the Finance Act that have passed, we've seen that the government the focus has shifted to revenue mobilization. We see that, for example, using SEPT as an example, the government is seeking to broaden the tax base and also has tried to reduce the exemptions that are granted to taxpayers. And like you can see, there have been no major changes in any corporate and individual tax rates. So this basically reinforces the uh, government focus on revenue mobilization. Another one is the shift to levies. So over the last 1.5 years, we've seen a lot of levies being introduced. We've had the housing levy, we have the railway development levy, which has now increased to 2%. Recently, the sugar development levy at 4%. From a carbon perspective, we've seen now with the increase in carbon projects in the country, we've seen administrative and issuance fees for carbon-related projects. So based on the government focus, it looks like they are now shifting their focus from increasing taxes to now moving towards levies. And finally, we've seen also an increase in administrative fees to access the government services. Recently, the government had increased the fees for accessing immigration services, processing of passports, processing of national identification documents. And so the question begs, or the question to you is, do you think the Finance Act is a game changer, or is this business as usual? So at this point, I'll invite Alex to take us to the panel discussion. Thank you.
Wow. Thank you very much, Dennis, for that very good presentation. So, as we promised, we were all looking forward to this session on, to just discuss with the panelists to get the ideas around this particular Finance Act and what it means to the economy. And I had introduced the panelists. Dennis has just presented. We have Cynthia Koech Moremi, Head of Tax, Safaricom. We have Christine Miner, CEO, East Africa Venture Capital Association, and of course, Dr. Abraham Rugo, the Executive Director at Bajeti Hub. And maybe to start us off, and in the interest of time, especially for Christine, you've heard what Dr. Abraham has presented in terms of how the economy looks like and how it's been performing over a period of 5 years. And of course, you've been looking at the changes that have been happening every year, and of course, even appearing before the National Assembly Committee to present comments on behalf of investors. What does this mean for the investment climate in Kenya? And what do you see as the trends?
Confirm my video is on.
Yes, it's on and we can hear you
clearly. Okay, thank you very much. As Alex has introduced, my name is Christine Miner. I lead the East Africa Venture Capital Association that is based in Nairobi and has a membership of 104 members with over $3 billion assets under management. So we are comprised of private equity funds, venture capital, and professional service providers, along with DFIs, family offices, and other stakeholders. Now we've seen, I think, over even the past 5 years, like you said, Alex, the tax environment has been much less conducive to investors, of course, due to the frequent amendments, which undermine the predictability, and which is a factor that is really discouraging investors and investor confidence in Kenya. As IAVCA, of course, our mandate is to ensure that we are attracting more capital into East Africa. And so having an unpredictable environment really does not help our efforts in that sense. And I think over the years and through the presentations that we've done in Parliament, that is one of the key factors that we are insisting to the government, that we need to make this environment more predictable. You don't have to, have investors put in investment and then 5 years down the line when they're exiting, you've gone through probably 3 or 4 amendments, and which affects the returns. And then so at the end of the day, you find that Kenya is becoming probably less attractive for investors, and especially investors who are looking at patient capital coming into the country. However, that said, we noticed that in 2024, Kenyan startups attracted approximately $638 million, accounting to about 29 to 30% of the total continent VC funding. So therefore, Kenya has been leading 2 years in a row in the startup funding space. And I think for us, this has been quite encouraging. And I think looking at just NIFC, policies that have come that are giving incentives to these startups, we are going to probably see an increase in that funding. And just to let you know that as much as Kenya's funding has been increasing in VC and startup, we've seen an overall drop in Africa funding from 2.9 billion in 2023 to about 2.2 billion in 2024. So Kenya was definitely among the only major markets to record growth, raising about the 638 billion. So that is encouraging for the startup sector, and for us is to probably just offer more technical assistance to the startups because the funding is coming, but then of course over the years we have to start seeing returns so that we don't see that funding again moving away like we did over the years for private equity. Now for private equity funding, because that's VC that is channeled to startups. For private equity funding, we've seen a hit in this sector, and particularly because, like I said, unpredictable policies and amendments every year. And so we are seeing a lot more fund managers deciding to either reduce their teams here in Kenya or rather just choosing other jurisdictions that have better predictable policies. When we look at our counterparts in Uganda, we're seeing that, the regulation is much more friendly. They just introduced a partnership regulation that allows private equity funds to register. They have they have an exemption for capital gain tax, which has been a continuous conversation between IAFCA and the government agencies, I think, for the past several years, where we've seen capital gains tax increase. And now we're seeing that for any non-SEZ entity that is exiting, then they will not be exempt anymore of the CGT because they're not an SEZ entity. So this further again discourages the investors' confidence within the country. But overall, I think we are still pushing, of course, for more capital. When it comes to capital flows into the country, we're seeing a reduction of flows from certain regions, probably like Northern America, and seeing more capital flows from Europe. But I think we are continuously trying to have these conversations with government. FDI has reduced, but private capital funds have increased. But I think if we continue with these kind of changes and amendments, we might see a reduction in just the funds that are setting up within the country. So we are seeing both. I think it's a mixed reaction. We don't have a lot of changes with the 2025 Finance Act. I think the 2024 and 2023 were very contentious, but however, we're not seeing very many changes with this Finance Act. And I won't go back to the points that have already been shared as pertains to NIFC, but maybe to mention the introduction of the Advanced Pricing Agreement, which allows PE funds with cross-border or related parties transactions who are able to pre-agree on pricing methods with KRA up to 5 years. So we see this as a positive move within the industry, and especially because most of our fund managers and most of the investments are really cross-border. And this also really, I think, is a good move towards encouraging the cross-border transactions that we've been seeing and been encouraging across the East Africa region. I think I'm seeing Alex, you're on. I think my 5 minutes is up, but open to any questions on this space. Thank you.
Thank you very much, Christine, for that. It's good to hear the kind of investors that you're working with, and to say that the money is still coming, but there's a dip, and also there's some form of alignment for PEs trying to just restructure the operations to just adapt to the economic environment that we have. I want to move on to Cynthia, who is head of tax at Safaricom. And Cynthia, for you, one interesting thing that was attempted with this particular finance bill before it became an act was to integrate systems with, for businesses with KRA systems. So, from your standpoint, what's your view on this over and above just what is happening on the digital economy from a tax perspective?
So thank you, Alex, and please confirm that you can hear me and my video is on.
Yes.
All right.
Proceed.
Thank you. So actually, prior to the proposal to then introduce a provision which empowers the commissioner to access much data, we had actually seen the commissioner asking for data for over and above what would then most of the time file in our tax returns. And of course, because we are one of the data processors in Kenya, and probably even the largest data processors in Kenya, we were always cognizant of the fact that the Data Privacy Act placed some obligations on ourselves, and knowing that a lot of the PPIs, the private personal information, is very critical to people, and they would also want us to properly manage their data. We definitely then were going to go with what the Act says, and we pushed back a lot to the Revenue Authority. So we were very happy to see that the Finance Act deleted that provision to even integrate over and above the other financial information that we had, but also PPI and trade secrets that the commissioner wanted access to.
And thanks for that. Maybe from a digital economy perspective, and considering that Safaricom is playing in the fintech space, what was your view of the impact of this particular act in the fintech space? Did it affect you in any way?
Is it the one on the integration?
No, over and above
Generally.
integration,
Okay.
from trying to, what we've seen over the years is government says they want to leverage on tech, and Safaricom being one of the tech companies. Government also wants to ensure that over and above leveraging on tech, then target anyone who is within the digital economy to try and tax them. So they tried with digital asset tax, that didn't work out. Now they're trying excise duty in some shape or form. But again, we still have this idea of trying to encourage our youth to be creative within their space. They are free to speak, number one, and two, even your data and etc is affordable. So this mix, how does it play when you think about this Finance Act and basically the trends that have been going on from a tax perspective?
All right. So thank you, Alex. Maybe before I speak to the Finance Act 25, I could start by saying that Kenya's Vision 2030, one of the pillars under the Kenya Vision 2030 pillar, is deployment of world-class infrastructure. And in our case, it would be deploying digital superhighway because of the role of ICT in Kenya, especially where the government is trying to position Kenya as a silicon savannah, and with us having a bulging youth population who are mainly going into the creatives space to try and earn some revenues. So I would say first, and maybe also just to talk about ICT and technology. So most of the time when we speak about digital, most of the time people tend to think it is just about internet and calls, etc. But ICT is really very critical across all spheres of industries within the nation. So if you're looking at health, you're looking at fintech, you're looking at education, manufacturing, ICT will play a very big role even as technologies continue to advance and to evolve. So coming to the Finance Act 2025, we were happy, and Dennis has already spoken to it, that there wasn't really a significant, or we did not actually see a change in tax rates, both for transactional taxes and for income taxes. And also speaking to what Dr. Abraham has also spoken about declining revenues. So of course, every time when we see the tax rates going up, we know that disposable incomes are under pressure, and therefore we were happy that the tax changes did not apply to tax rate. But now coming to the ICT industry specifically, one, the finance bill had proposed to change the VAT status of locally assembled devices, which was then changing from zero rate to exempt. The zero rate had been provided in 2023, and really just looking back at how the tax laws have evolved, we're seeing some level of instability, because in 1 year we see an increase, in another year a reduction, in another year a change in policy strategy, maybe from zero rate to exempt, without really first evaluating the benefits that had been achieved for the purposes of having had the amendments in the tax law. So we had lobbied to have the locally assembled device zero rated. It was part of the strategy, also hinged under the Vision 2030 ICT strategy. Why? Because a device is normally an enabler as opposed to it being a sellable item, as the case may have been. So it was, of course, a bit interesting that 2 years down the line, they were then proposing to amend the laws to then change the status from zero rate to exempt. So we are happy that the status quo is maintained in the Finance Act 2025, so that then the device can become affordable to the ordinary mwananchi, who are then able to utilize the phone to access digital products. The other one that was really big for us was the introduction of investment allowances on spectrum licenses. So spectrum licenses are a key ingredient in either setting up an organization, or as technologies evolved, we started with 2G in 2020 when all these telcos started. Today we are at 5G, even looking at 6G because of the various opportunities that ICT and technology can avail. So it was really a welcome amendment to introduce tax incentives, not only for future investments in spectrum license, but also giving us allowances for licenses that we've already paid in the past. So Christine also talked about the introduction of APAs, which is really a very welcome move, considering that with the shrinking in tax revenues, the Revenue Authority is also intensifying tax audits. And of course, it would be really very useful for us, where we then have these pre-agreed frameworks, which at least lasts the 5 years as prescribed, so that it can give us some semblance of stability and certainty as we continue engaging with our related parties offshore, taking note that, of course, we have the developed ones that are slightly ahead of us, and we are able to borrow best practice from them. Thank you.
Thank you. Thank you very much for that, Cynthia. And perhaps I'll get back to you, but as I get back to you, maybe you could be thinking about this question. So over and above integration, I think data plays a very important role in terms of, so we've seen the KRA move to electronic tax invoice management systems. We are soon moving into some form of system to also take care of guys who are earning rental income, and basically to just have a system for that. And within the income tax, we also have a proposal that, it's not even a proposal, it's law, that going forward, expenses that don't move through e-teams then will be disallowed. I'm sure then data plays a significant role, because without it, then of course you can't be able to relay invoices. So you'll be thinking about how does then Safaricom support that. But as you think about that, let's move on to Dr. Abraham Rugo. I think yesterday we saw some news circulating to say that we are now moving to securitization, and it was labeled a very hard word, where we then borrow over and above what is provided in our Public Finance Management Act, vis-a-vis the safeguards that have been provided in the Constitution. and now we are moving to other forms of creative ways of getting money. So what does that mean for us, and do we expect this to continue given the fact that our revenues then are not enough to take care of our budget?
Thanks a lot, Alex, and I really appreciate the perspectives by Christine and Cynthia. So this securitization, simply defined, is where you use, as is the case in other places, where you use a certain collateral that you have to be able to take a loan, and therefore, with the plans that you will be able to. So in this case, we are, as a country, in a move that, from where I sit, I think is perhaps not the best direction, if you ask me. We take two funds. One is a sports fund, largely gets its money from betting, and it was supposed to be a certain percentage is used for development of sports development and what have you. You securitize, so you use a portion of that and take some couple of billions to build. So there are two areas of concern. So the second one is the one against the road maintenance levy fund. Again, the 7 shillings to the petrol, to the liter of petrol. My concern is that when you go that direction, already you are dealing with a debt burden that is already difficult enough to be able to service. At the same time, cost of living is becoming heavy, and one of the key drivers of the cost of living is fuel. In this case, I'll come to betting in a minute. But if you think about fuel, so petroleum particularly, first of all, it's a product that we do not produce. In other words, we are at the, for lack of a better word, we are the mercy of the people we import from. And therefore, when you technically hedge, say you're going to be depending on this so much amount to be able to offset future loans. The direction of the world is that one, we are moving away from fossil vehicles and moving more to electric vehicles. The cost has been, from time to time, the cost has been going up. The landed volume of petroleum has actually been declining, even as much as the pump price has been going up. But thirdly and lastly, around that, is that when you do the analysis of the cost at the pump of petrol especially, you realize that the taxes, including the road maintenance levy fund and all the taxes that are charged, are actually more than the cost of the product, of the landed costs. I think we are at 83 shillings against 81. The landed cost is 81. Our total taxes are 83. So we are at about 1 or 2%. Why is that important? Is that, first of all, you are almost locked into having your fuel costs permanently at a higher price, because a portion of that is what is supposed to go and offset this loan that you have taken. Two, the loan that you have taken is largely to sort out pending bills. It is not necessarily to build any new services. It's not to produce any new services. It is not to build any new, to maintain any new roads. It's basically to be able to offset pending bills. There, a big question around accountability rises, because if the money that was meant for the bills you're talking about was actually spent, but these bills were not paid, should you be making provisions on how to sort out those pending bills, or should you actually be sorting out the accountability question as to why in the first time? On the betting, that is a sports fund. And there's a discussion again to be held about the percentage at which, the transparency within which these things are being taken, the interest rates which are against which we are taking this. For the betting again, are you saying that actually you expect betting to increase? Now, when you look at betting, you know very well, it is a game that is largely being played as in lieu of incomes. In other words, it's a game, it's an addiction. Let's start there. It has its own health implications. But more importantly, are you saying that actually as a country, we have an expectation that people will continue betting more and more? and therefore we'll be able to make more and more from that particular fund, and set the money aside. So there are questions, but for me the bigger question is the accountability question. What do you do then with all these other funds that you have not pending bills? If you put the two funds together, for Atalanta, it's 45 billion. If you take the one for road maintenance, 175 billion together, that gives you just about okay. For Atalanta, is actually going to build, the Atalanta, the sports stadium, but 175 against 706. Yeah, I showed you the figures. What happens to the rest? Are you going then to be securitizing something? Are you going to securitize share so that then you clear bills in healthcare? Are you going to securitize school fees so that then you clear bills in education sector? I don't think it's a good direction to go, because I would rather we find other way, not find other ways. We deal with the accountability questions, but ensure that first of all, money that is set aside for public services is actually spent for public services. Thank you very much.
Yeah, thanks for that. And maybe a follow-up question then is, I think as part of your slides, you're mentioning that the real income is on the decline. Employment, like we see, is also on the decline. And we know that currently we are perhaps relying on about 3 million people who are paying pay-as-you-earn. There's been debate to ask, then do we move to indirect taxes, perhaps do something around the VAT and reduce the PAYE? Or from an economist perspective, how do you see this?
Thank you, Alex. We are not going to run away from ensuring, and I know in a previous debate somebody challenged me asking me, why am I pushing for incomes, not employment? So you have, according to official statistics of the Kenya National Bureau of Statistics, you have 20 million people who are employed. Of those 20 million, 175,000 of them are in household self-employment and unpaid care work, largely women who work in homes and in family businesses. But then you have 3.2 million who are in wage incomes. In other words, majority perhaps of the people on this call who receive a check at the end of the month with a deduction of pay. And therefore, a big part of the discussion has to be, now, these 17 million, these 17.7 million people are the ones we are saying they are hard to tax, because then they don't file tax returns. They have erratic incomes. Today they have 30 shillings, tomorrow they have 0, the other day they have 300 shillings, the other day they have 100. They are erratic. They have erratic incomes. They are not dependable because of the nature of the businesses that they do. Two, it's not, a lot of the jobs in the informals, as we call it in the informality, are not jobs that are created. These are jobs that you find yourself in because you have nothing else to do. You have to, you're a broker in a market, you run a kiosk and the like. But at the same time, these are the very people who are targeted by indirect taxes. Now, indirect taxes, as you know, are very regressive. Take an example of VAT. If you go for standard rating at 16%, you are applying 16%. If I buy a product A that has a 16% VAT, the person earning 100 shillings pays 16%. The person earning 100,000 shilling pays 16% for that product. When you prorate it, you realize, for one, if the one person earns 200 shillings, they spend 8% of their income on tax. For somebody else at 100,000, perhaps is 0 point something percent. So, but the direction we are seeing actually is going in two directions, in two routes. The first route is that we are seeing seemingly a target of increasing VAT and the like. But remember that VAT, excise, and import are a factor of incomes. So if your incomes are not improving, even if you increase VAT, the quantum of growth, remember, for instance, when petroleum was standardized to 16%, you remember that there was not necessarily a growth. When excise duty on data, or is it voice, I forget, was increased, there was not necessarily a matching growth in the amount of tax, because all this has to do with incomes. No incomes, no tax. And I could even push it further and say, and when people don't get past the kind of public services they expect. So that's important to speak. But secondly, on the other hand, we are seeing an increase in direct, almost in co-payment arrangements with government. For yesterday, if not today, I've had Treasury has announced they are reducing capitation for education. What does it mean? If you reduce it from 22,200 to 16,900, it means the difference has to be borne by parents. These are the same parents who are you expecting to collect VAT from? You're expecting PIN, personal income tax. But thirdly, is that we are also seeing, related to that, we are also seeing an increase in terms of target. If you look at the analysis of the numbers for the coming year, we have a huge shoot of about 70 billion in A&A, in other words, on charges, on levies and fees that are charged by government for provision of services. One could argue that we expect more people to access more government services that they are willing to pay for. That's one. But it also simply means, if you looked at government from a business angle, you could argue that government actually expects to sell more of its services. Now, these are services for which you have already paid taxes for. So from an economic perspective, I worry that this will increasingly again edge out activity, disposable income within the economy. Then it means, therefore, then it has the ripple effect, the usual ripple effect. People don't have proper disposable incomes. They are not able to access credit for purposes. They are not able to invest. Then it reduces our national savings. And the ripple effect is that finally, you find yourself tied in a situation whereby you are increasing the rate does not necessarily increase the contribution, because you are targeting the same people. Perhaps the direction should be, is it time to actually have a conversation of how can we, to the extent possible, reduce the rate for the regressive taxes? And then for these people who are paying the 3.2 million, who are contributing, let me use the word contributing, involuntarily, income tax, we reduce the rate, so that then they have a disposable income, because, and this will be my last point on this, because these are the same people who provide a social safety net for majority of Kenyan households. Each of us in this call, I will not be surprised if you're not paying school fees for some 2-3 other children of your relatives out there, if you're not on a WhatsApp group for a medical bill, yet you are contributing your share, perhaps at more than maybe 4,000, 5,000, as it were. So you cannot take from one side and expect to reap from the other side. You have to facilitate the other side. I mean, one side, so that you can be able then to gain from the other side. That's my concern. Thanks.
Well, I think what you're saying is it is better to maintain it as it is for now, and then perhaps gradually then reduce the VAT rate, and perhaps also reduce the personal income tax rates. And again, I think we see that plan within the national tax policy and the medium-term revenue strategy for the government, and we can only hope that they will implement those ones in the fullness of time. So I want to welcome questions from our participants. So please feel free to type in your question in the chat or Q&A, so that we're able to address those questions. Sain Karushka, maybe you can let me know if we have any question. And as you look at that, I'd promise to come back to Cynthia around this is where we are. Kenya, we like using our phones. We like using data. We call tech savvy, and just so we think then that Safaricom and telcos basically play a very important role in just keeping that connection going. Are there initiatives that perhaps that are there to just ensure that keeps going, especially with the revenue front?
Yes. So, Alex, and I hope I understood your question well, whether there are any initiatives from the telco industry to ensure that we remain connected all the time. So if I was just to use Safaricom as an example, there is a lot of innovation that comes in, I think from practically all the telco service providers. And as I mentioned earlier, we keep on seeing an evolution in technology. So about maybe 10 years ago, we could not do the virtual reality, Internet of Things. It is now becoming a reality. Previously, we could not stream videos to our homes. It is becoming a reality thanks to evolution in technology. So yes, we continue to see new service offerings coming through, what we call use cases. And this is also mainly driven by our own population here in Kenya, because if you look and compare across the Eastern African area, and also looking at some of the data, you'll find that Kenya is, I think, the highest country in terms of the number of hours that its people are on remain connected within internet, and I think it's about 5 hours, with being the top country globally on internet usage. I don't know whether I've answered the question that you had asked, and maybe I could also speak to the question you had asked on the relevance of data based on what the Revenue Authority has been seeking from an integration perspective. So I will speak to the what, which is the integration of data, or the relevance of data to both the tax administrator and to the taxpayers, because I believe that if they are then able to have access and we are all transmitting our data correctly and as required, it then sort of equalizes the tax burden across all. The issue for me would be the how, and especially speaking to the more recent e-Teams deployment, where in my view, it was done hurriedly, and not very many people were given an opportunity to pilot the platform, so that then would be able to give feedback that would be inbuilt to ensuring that everyone had a very good experience as a user of the platform. But that, and a good example would be last year, I think it was last year, when we were then forced to file our returns using the auto-populated provision within iTax, and on the last day it failed and we had to go back to our manual processes. Then quote unquote forced to then use to apply the auto-populated template in November, where we've seen mixed supplies. And considering that Safaricom has touch points practically in all industries within this nation, we continue to see a lot of challenges because we interact a lot with most taxpayers in Kenya. So either the Revenue Authority did not communicate effectively on what was required, or sometimes there are hitches on transmission of information, etc. So the how probably could be improved, but then the what, probably there's a justification in the Revenue Authority seeking to try and, as much as possible, to get access to this data. And hopefully, if used well, it should be able to then distribute the tax burden across evenly. Alex, back to you.
Thank you for that, Cynthia. I'm just checking if we have any questions. So for all of us who are here, there is at the top there the Q&A chat box. Leave the chat. Just go straight to Q&A. In case you have any questions for our panelists, please go ahead and ask. Within the questions, there is a survey that has been posted there by Sane. Kindly complete that particular survey. It will help us to improve on the next webinar that we'll have, or the next discussion. So as the questions then come in, I know Christine has asked to leave because of a pressing call, but maybe I'll take it back to Dr. Abraham. So looking at our economy and looking at our tax performance, are we surviving or are we thriving? And depending on your response, if you are asked, what 3 things then do you think we should do, assuming the answer is surviving? Because I'm sure there are revenue authority guys also listening in.
Wow, that's an interesting one. But allow me to say something that perhaps may surprise you. I actually think from an income perspective, we are thriving. This is my argument. If you look at the last literally 10 years, our average income growth year on year has been at around 10%. Now, there are very few people on this call who have had their income increase year on year at 10% and above. In fact, the only year we had a bit of a dip, I believe, is 2020, 2021 because of remember the tax measures that were put in place to help people manage through COVID. So from that perspective, I can argue that we're actually thriving. In other words, we are able to raise more and more revenue year on year. What we are not doing is that because of that appreciation that we are able to raise our revenue year on year, I worry that we are overestimating our expenditure. Again, raising our revenue targets so high to be able to say, no, maybe because we could collect, it's that argument of if they can pay 5 shillings, then they can pay 6 shillings. If they can pay 6, why can't they pay 7? And if they can pay 7, and you continue increasing that to your factor, n factor, whatever factor you have chosen there. So from that perspective, I think where we are purely on survival mode is that our expenditure, as I have just explained, is outstripping our targets, our revenues. Because think about it, 2.4 trillion this financial year, 2.5 trillion this financial year, the previous financial year, that is 10 times what you raised 20 years ago, where you were just at about 20 in 2002, 2003, you were at 250 billion. Now you are at 2.5 trillion. That's, who would have imagined, that kind of a growth? I think there are perhaps with that, because again, as I've said now, so it's that mixed picture that you're surviving in trying to match your growing revenue so your revenue is growing at about 10%, your expenditure is growing at about 30%. So in other words, at 3 times, that speed. What that means is that then you have immense pressure on the Kenya Revenue Authority to collect, literally squeeze water out of this rock. 2, there still seemingly has been no decision made of how to formalize the informal. I don't know why there is fear. I know, is it politics? Is it the fact that these are numbers? But the reason why I think it's difficult right now to formalize the informal is just because of the things I said. So you have tax is just one side, and the formal tax as we know it, VAT, excise, whatever. Now we have not talked about the levies and the charges and the fees, some of which run into tenfold levies. I remember I was in a talk somewhere and somebody was saying actually there are certain value chains that you have up to 53 licenses, fees that are paid to this one, that are paid permits, what all these things that are being charged by different players. So I think there is space to first of all make the business environment more conducive, which is a regulatory action. Because what that does means then that if there is more incentive to formalize your business than to keep it informal, because then it's a survival technique to stay informal, because once you formalize, KRA comes after you with all the various the different bodies, the NEMAs of this world, the health protectorates and whatever, all these bodies that are supposed to be collecting certain levies, because these are the levies that keep the 248 state-owned state enterprises basically functional as it was. Secondly, service delivery is a non-negotiable if you're going to improve tax morale, but also if you're going to spend, in a way that shows that you're putting your money where literally your mouth is. And right now, I think what is really troubling for Kenyans is not being able to see the commensurate service for the taxes that you're paying, because everybody pays taxes if you include indirect taxes, and therefore that matching of service delivery, to the taxes that people are paying. I think a third one is something I have spoken a bit more passionately about, is that we still we have a size of government that is perhaps unproportional to our size as a country. We have these 47 county governments, each with a governor, each with a county assembly. I know this is not a very popular line, but allow me just to continue with it. Then you have a national government with now, I think, almost 50 departments, 248 state agencies or thereabout. Then you have, the houses, and each of these has got overheads. Some of them are actually doing duplicative roles between the county government, national government, and in the in between there. If we don't address the cost of running government, it's basically like your business. You continue to have an office in Nakuru, in Kisumu, in Mombasa, but perhaps, in 2 or 3 of those cities, there's no business going on, but every month you still have to keep the office open. You have to pay for electricity, you have to pay for security, you have to pay the staff who come to open that particular place. With time, it will catch up even if you have very high revenues from one of the offices. So I feel that idea that you're running government, then you find yourself in a situation where you're looking now for money by all means necessary, including securitization, to be able just to keep the wheels running. But from an income perspective, I think we are doing very well, because that income, I believe, actually, from what we collect, we can deliver most of the public services that Kenyans are desirous of. Thanks. Sorry, you're on mute.
Sorry, I see 3 questions there, which we'll answer shortly. And for the participants, I kindly request you to stay with us for another, perhaps maybe 5 to 10 minutes, and we'll wrap this up. It's a conversation that definitely needs to continue because of the kind of impact it has. And Cynthia, I think same question. Are we in thrive or survive mode from where you sit? And what perhaps 3 or 2 things do you think we can do?
Okay, thanks, Alex, for your question. So my response won't be similar to Dr. Abraham. I'll only look at it from a procedures perspective because I then implement the tax laws. I would say we are somewhere in between thrive and survive, especially when you look at the various procedures that we're required to fulfill as part of compliance in the law. And let me even just use an example of e-teams where when we're looking at the informal sector, so we have very many people who would want to make supplies to the formal sector, but we are placing onerous obligations on them to comply from a documentation perspective, in some even instances requiring them to have PINs. And it was just to use an example where we would normally have our operations right at the machinani, and sometimes you want to promote the person on the ground, you want to buy their products, they do not have a PIN, yet I as a corporate am required to have a PIN, an invoice from that person that is in line with the prescriptions of what a tax invoice would require. So there's a bit of a challenge there, and maybe there should have been a threshold, especially where you then have the corporate or the formal sector then interacting with the informal sector, just to ensure that we are elevating those sectors so that they are able to then grow. From a growth perspective, and Dr. Abraham is right, we have seen instances where there's an increase in the tax law, but it does not necessarily yield the revenues that the government sought to speak. And if I was to use an example, I think it was in 2021, the excise duty on telephony services was increased to 20%, but we actually saw a drop in uptake of the products. And only now in 2023, when the rate was reduced back to where it was in 2021, then we saw an uplift in consumption of the products. So I think what the government then needs to do is to really have a proper drill down or a double click on some of the policies that they come up with, and then maybe just try and relate it to what happens on the ground. And I was really happy with what Dr. Abraham talked about, because if we are not growing revenues, which we always see as a very big risk for all corporates, because when we see disposable incomes going down, then it is really a pointer that the uptake of products will slow down, because it is this same revenue that is supposed to be applied to buy the products that all of us who are in business are selling out there.
All right. Thank you for that. Patrick, your question on the impact on increasing taxation on disposable incomes. I believe that one Abraham has spoken about it and insisted that we really need to ensure that we have better disposable income, and that translates to better revenues for the government. Maybe this one is to you, Cynthia. The question from Alfred Okanga, who asked if the taxman can access pay bills and till numbers.
Okay, thanks, Alex, for the question. So the answer is no. The taxpayer cannot access information that is contained in the pay bills and in the till numbers, because what the taxman can only see is the transactional revenue that Safaricom earns, and there's actually a provision that they can only access that information subject to a court order, and by the time the court order is sought, they will already have had engagements with the taxpayer, and in most cases, the information would only be sought so as to corroborate the information that the taxpayer has presented to the commissioner, just to ensure that it is a match for what has been presented.
All right, thanks for that clarification that the taxman has no access to the pay bills and the Lipa and M-Pesa platforms. A question here perhaps to you, Dennis. This is from Guy Carey, who asks, how is the 5-year cap on carry forward of losses expected to impact the economy? He says there's been an attempt to introduce it before and it failed. And he gives a comment that government should actually, it's trying to take a view to rein on perpetually loss-making companies. What is your comment on that?
So what comes to mind in relation to the capping of the carry forward is that this will affect companies that are in capital intensive sectors such as manufacturing, because you find that companies or taxpayers in these industries may not recoup the investment within a 5-year period. So capping it to 5 years might be difficult for such taxpayers. And also you'll find that for mergers and acquisitions or such deals, then taxpayers that have tax losses that are huge, which might not be recouped within a 5-year period, then become less attractive. And then now you find so many companies might go under, and this might also discourage investment into these sectors. So I think that would be my answer for that.
Thanks for that. There's a question from Purity Ndeto, who asked, the Finance Act in Kenya introduced a tax exemption for gratuity payments made to employees in the private sector. Does this amendment affect the age limit of employees? To my mind, no. The age limits that are provided to access pensions continue, and there's no prescribed age limit for gratuity. Is that the case, Dennis?
That's correct. So it doesn't affect there's no any age limit for employees here. So basically the exemption was to cover both private and public sector. Yeah.
Thank you. Then there's a question here. Is the application of excise on betting deposits before the punter has even engaged in any betting constitutionally sound? I guess here you can see where the question is coming from, but Dennis, what's your comment on that?
I know there is a pending case by taxpayers on excess duty previously, and there are conservatory orders that were issued. And as recent as November last year, the High Court addressed this matter. So we can wait and see what the court will decide on the same. But yeah, I think I agree from a constitutional perspective. If you look at article, okay, forget the article right now, but yeah, I think there's an issue there.
Yeah, and I think on this one, the argument here is you are taxing income. If there's any income in betting, you're taxing the capital, the investment, the kuwekelea in Kiswahili, as opposed to taxing what someone has won. So it's quite an interesting thing happening there. But considering that this Finance Act provisions just came into force the other day, beginning 1st of July. We'll wait to see if that then gets challenged in court. All right, I think I've gone through all the questions. Again, to remind us, we have a survey that has been put there on the chat box by Sane. Please complete it and give us your comments. And because we are wrapping this up, I just want to give a minute and to Cynthia and a minute to Abraham to give their parting shot. Let's start with you, Cynthia.
Okay, thank you, Alex. And I'll only speak maybe from a Safaricom perspective and from a tax policy perspective. I have seen a couple, I can say over the last maybe 4 years, and probably because of what happened to Finance Act 2024, there is a sense of the government listening to the taxpayers. And I know sometimes it may be very difficult to translate that to the common mwananchi on the ground. Maybe it is an opportunity for us to actively participate in the tax policy or the development of tax laws in Kenya. In fact, as business carries on, then you are able to see areas of improvement, areas of suggestion that we can give to the government. 2025 Finance Act, not too bad, and we hope for the very best even as it is implemented in the coming year.
All right, Abraham, your closing remarks.
Yeah, thanks. I know I really appreciate the effort to discuss the financing, the taxation measures, and understand, their place. But I hope I have convinced you to spend a bit more of your engagement even on the expenditure side, because that is where everything goes haywire. Taxation only comes to fulfill a dream that has already been penned, and that dream is expenditure aspirations, as it were. And therefore, I encourage us to really pay attention to the expenditures, particularly in the sectors where we belong, be they agriculture, be they, the service sectors, the social sectors, and whatever other sectors that we are in. I think we owe it to ourselves to be able, because the implementation is where it becomes very, very, very critical. I think a second point, which is really building on that first one, is a whole question about pushing this governance and accountability needle. As the Gen Zs call it, injecting. By asking questions. Around where is the money being spent? Why is it being spent in that way? Are we leaving the national tax policy? Are we leaving the medium tax revenue strategy? So that then the more of us ask these questions, because these are political, they are technical discussions, but they happen within a political context. And ultimately they are political decisions. So the engagement, the more of us ask these questions, particularly those of us in the know-how, I think we can make a difference. And finally, thank you very much for inviting me and inviting Bajeti Hub to be able to engage in this conversation. We hope it's been helpful. Thank you very much.
Thank you very much, Dr. Abraham Rugo. Thank you very much, Cynthia from Safaricom. Thank you very much, Christine in absentia from East Africa Venture Capital Association. Thank you, Dennis from CDH, and myself and the team that was putting this together. I'm able to see Sane, Karushka, Prince, Charity, and the whole team, Heidi. Everybody was involved in putting this together. Thank you very much. And thank you to all of us for participating in this particular conversation. Let's keep this going. Look forward to actually getting more of this as we continue into the near future around how we engage from a tax perspective, an economic perspective, and basically shaping the policy of this country and where we head from now and going forward. So with that, I want to bring this to a close. There you have our contacts in case you want to reach us. Please reach us on our emails. You have your alexkanyi.cdhlegal.com, CDH Kenya, that should be CDH Kenya at cdhlegal.com, and our numbers, our offices are, of course, at Riverside Drive on the 3rd floor, Block D, and we're happy to really engage with you, not only on the tax side, but anything legal, because we are your business law firm of choice. So thank you very much. Enjoy the rest of your day. Bye-bye.